This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to 30 Deals in 30 Days. We are live from Nashville, Tennessee, diving into your random deals, right? This is the challenge where I am underwriting random deals from you guys from all over the United States over the next 30 days so that you can learn how to do it as well. If you want to get the tools that I'm using today, if you want to submit deals for me to underwrite, join the challenge. It is crecentral.com/30 deals 30 days. That link is also in the description below. Z is jumping in already saying, let's go for day 11. Excited to be diving into this one with you guys. Today, we're going to be working on another flex deal. This is one from, it looks like John Harris jumped in the Didn't mean to do that. We are live. Isn't that always fun? All right, let's try this one more time. There we go. All right, so this one is from John Harris. He's saying, Tyler, I found an interesting deal in my area, similar to day 9. Could be interesting to see the underwriting for it. Unique flex, an iOS property, industrial, 9,300 square feet. Maybe we could see it. Well, John, we're diving into it now. Let's see what we can do. All right, so right off the bat, looks like it's in pretty decent shape. I like seeing, it seems like we've got a little maybe truck yard here in the back. We'll see. He's saying, yeah, wow, that was fast. Yeah, you know what? It's funny. Like, I'm live producing these. I've got a little switchboard right here. I have no idea why that happens sometimes. But when I go to do the share my screen, it'll just start playing the bumper again. I'm like, all right, well, it's over. Thanks for joining us, guys. Amanda's saying, first live for me. Thanks for teaching us. Amanda, thanks for being here. Really glad you could make it. So hopefully I teach you something new on this so you could dive into flex space and start underwriting it. First off, right off the bat from this picture, roof looks like it's in pretty good condition, right? That's always nice. You don't have to worry about that. Lay down yard looks like it's pretty clean, pretty decent. Let me see. I don't know if I'm seeing any lighting. It seems like there's probably some lights. We're probably too far away to really tell. Lighting, fencing, security cameras, that's typically what tenants will want to see out of a laydown yard. Some sort of secured access just so that stuff can't get stolen. Sometimes they're putting down stuff that's so heavy, nobody's really going to steal it, but you never know. All right, plenty of aerials of the property. It looks like it's got several doors in the back. What is that? 1, 2, 3, 4, 5. That's pretty nice. So you could if this is one tenant now, you could very easily split that up into 5 without having to do anything besides put demising walls inside. Looks like it's even got, maybe 4 personnel doors as well. I like the landscaping. Building seems to be in pretty decent shape. All right, here's the interior. Steel frame construction. Looks like it's pretty well insulated. Concrete floors. A little bit of a mezzanine. All right, it's got some office built out. That's the end of our pictures. So I'm sure it's probably got a restroom. Let's see, before we dive into the flyer, let's see what else is going on in this listing. Built in 1996. Looks like it's probably been pretty well renovated since then. No loading docks. Not the worst thing in the world. Some people get caught up on not having a loading dock. To me, look, it's a flex building. Most of these tenants are not going to be using loading docks. They're going to be using the roll-up doors. 17 to 20-foot ceiling height, that's perfect, right? That is an ideal height range, asking $875,000. So if we do some quick back-of-napkin math, 875 divided by 9,300, we're at $94 a foot. If you guys want to know my trick for what I would do right after that, I actually haven't shown you all this in 30 deals, but I've taught this on the channel before. If you wanted to see right off the bat, if this deal makes any sense at all, like just pure back of napkin numbers, what I would do is I would take that. I personally like to do my deals at a 12% cap rate, meaning that by the time the deal is stabilized, it should yield a 12% cap rate. Some people have said, well, Tyler, that's completely unrealistic. You can't find 12% cap rates. And yes, you can. And this is probably one of those deals where you could actually stabilize it at a 12 cap. Now, that also takes into account the fact that I'm probably going to have to spend some construction money on it. So maybe it won't get quite to 12. Maybe it gets to a 10. But that's a deal worth doing. So what I would do, we're at $94 a foot, right, to purchase this thing. What I would do is I would just multiply that by 0.12, the 12% cap rate that I want. So that gives me a triple net rent number of $11.30 a foot. $11.30 a foot. So then what I would do from there is I would just go, let's just do it right now. Where are we? Lorain, Ohio. All right, let's pull up Crexy on another page. I'm going to show you guys what I would do in this case. So I'm going to go to industrial in Lorain, Ohio. And I'm going to see if anything is available for lease in that range. Now, if all of the comps are below $11.30 a foot triple net, probably not a deal, right? Because all of our comps are going to be below us, right? At least I can't get the yield that I want to get. If all of our comps are above that $11.30 a foot, let's say everything is leasing for $14 a foot triple net, I know, hey, I can deliver this at a below market rate and still get a 12% cap rate for myself. Undisclosed rates, that is always fun to deal with. Let's remove these boundaries and see if there's anything else in the immediate area that might give us an idea of what these prices are. All right, I'm just going to cut out undisclosed. To me, it's just a lazy broker. $6.50 a foot, but look, this is for a 30 to 60,000 square foot warehouse, so that's not a comp. And we are out. So it doesn't look like anybody's really sharing their rent numbers in this area. We'll go a little further out. All right, here we go. $8 to $12 a foot, kind of retail, kind of flex, right? Depends. To me, I would say as run down as this is, as tired as it is, you're probably not getting a lot of retail tenants going back in here. That could actually be pretty good for some flex tenants. But it's an old shopping center, not very nice. At least we know, hey, $8 to $12 a foot. Okay. $12 a foot. There you go. This is all types. You want to be an industrial. $9.90 a foot. Ooh, prime spec build. That's for a build to suit. So we would have to get the terms for that, but if somebody's building new construction at $9.90 a foot, probably not going to work for us, right? Because that comp is below the market rate of what we are looking for. Oh, man, there's no comps in Lorain, Ohio. All right, well, this is a fun challenge. Let's see what everything is leasing for in Lorain, Ohio. Doesn't look like much of anything. So, John, what this tells me right off the bat is that this may be a really bad area to be investing in. You're probably too much of a suburb of Cleveland. I wonder what's happening over there, right? Cleveland seems to be doing okay. But if you can't even get into the suburbs and start to see what comps are and start to find stuff, that to me says that there's not enough supply on the market, and it's likely due to not enough demand. Right? If there was so much supply on the market, all those spaces wouldn't be undisclosed. So, red flag right off the bat. All right, well, based on what we just did, I would say, yeah, my back of napkin math probably doesn't work on this deal, which means that this deal is probably not going to work. But there you go. There you have it. That was like a 2-minute, 3-minute analysis. Let's dig into it a little bit more and see what we can find. All right. So sits on 2.5 acres, heavy industrial zoning, excellent highway access, zero point 0.7 miles from Route 2, 8,600 square feet of clear span, 658 square feet of office space. That's nice. The only problem is, like, once we start to demise it, we're going to have to build some more office space. So we're going to have to spend some money if we are actually going to demise this into smaller suites. But it may not be worth, 220 volt service. That's nice. It may not be worth demising this into smaller suites because there may be zero demand in this area. There was one comp that we saw that was new construction, and it was build to suit, meaning that they weren't even willing to build it on spec and to try and lease it from there. Okay, total population in a 3-mile radius, pretty low. So Z is saying, can you turn that warehouse into half retail, half warehouse? You sure could. Depending on the zoning. I mean, I don't know if I-2 heavy industrial zoning would make sense. I don't know if this neighborhood would make sense for retail. I mean, if the zoning permits it, you always can turn one of these buildings into something else. I mean, they're just boxes, right? So it's just a matter of spending the money to get it to where somebody would want to put retail in it. But it's probably not a neighborhood that anybody would actually want to open retail in. Looks like service repair garage is what it's been. All right. Not a lot to glean from the offering memorandum. So let's actually go look at this on Google Maps, see what we're looking at here. Yeah, with the address being Industrial Parkway, Z, I think it might be too far gone for retail. Yeah. Yeah, not a retail area. There's a little building across the street. I mean, it's a nice enough building, right? This seems like a pretty decent building. The thing that I'm worried about is there actually any demand whatsoever? Because it sure doesn't seem like it. I mean, keep in mind, I wasn't limiting it by square footage for lease demand. I wasn't limiting it by flex space only. That was all industrial in this area. And there was almost nothing. Okay, you know what? Commercial real estate report, Cleveland, Ohio. Let's see if we can find some sort of report or market analysis on Cleveland. Reject. Cleveland office, Cleveland industrial. Let's look at this. Q3 of 25. So this is fresh. So if you want to get to know a market pretty well, go through one of these reports, right? It's going to tell you. Cleveland industrial market posted negative absorption of 517,000 square feet in the third quarter. That means that 517,000 square feet net vacated buildings in the Cleveland industrial market, right? And Lorain, Ohio is part of that. Let's see if Lorain is mentioned at all. Let's see if suburbs are mentioned at all. Nothing. Okay. The metro economy gained back a small number of jobs. Total non-farm employment increased by 1%. Sale leasebacks have become increasingly more popular in Cleveland. Interesting. I mean, that to me is saying that companies are really needing to free up some cash. They're getting into some issues. Typically, a company's not going to offload their commercial real estate if they don't have to. Like sale leasebacks are great. I love them. Great thing to do. You can get a brand new, fresh lease, great lease terms. But you got to ask yourself why. Why is this business selling this real estate and signing a lease instead? Because they lose control of their destiny when they do that. All right, unemployment and non-farm employment trends. Unemployment's pretty decent, 4.3%. That's not bad. Non-farm payroll looks like it's trending downwards. right? That's not what we want to see. It means you're becoming too heavily dependent on agriculture, which I mean doesn't necessarily spell anything bad for industrial real estate. That could be a good thing, but you'd have to know that you just have to study the market a little bit more. Both significant industrial using employment sector see annual job gains. Okay, 0.1%, negligible, 1.5%. That's pretty, seems good. All right, leasing market fundamentals. Let's see. Cleveland's industrial market posts 5th straight quarter of negative absorption. Yeah. 5 quarters in a row, a year and almost a year and a half of negative absorption. Really, really bad. So that 517,000 square foot number that we were talking about was the second largest negative number since the second quarter of 2021. Industrial vacancy, oh my gosh, look at this. Industrial vacancy rate increased by 30 basis points to 5.5% for the quarter. Not terrible, but not I mean, that's like 5.5% vacancy across the country right now. That's high, generally high. Several large chunks of space came online as vacant in the third quarter. Tenants downsize or consolidate space. Circumstances far outweigh the large occupations and delivery. So there was only delivery of 394,000 square feet of fully occupied new construction. Despite the vacancy uptick in a 5th straight quarter of negative absorption, the year-to-date vacancy remains at 5%, still well below the long-term average of 7.4%. So that's not bad. It's not great compared to the rest of the country, but that's not bad for Cleveland overall. But this is not telling a good story right here. Leasing back down. Demand declined again after a second quarter rebound. So you just look at this trend, right? Like you may see these little peaks right here where it catches up, but look, since 2022, demand has been trending downwards. People are not wanting to lease in the Cleveland market. Class A warehouse leasing volume lowest since 2021. Why is it slowing down so much in this area? That's kind of wild. Industrial sublease availability back up by 72%. Construction pipeline declines. That means that people are not very positive on the outlook for demand, for absorption of whatever they're building. Industrial year-over-year asking rent growth negative for the 4th straight quarter. So rent growth has been negative for the past year, trending downwards. It looks like it's gone down 4%. Look at that. That's a pretty stark swing. Like in 2022, it started going down. Remember, we said in 2022, since then, leasing demand has slowly gone down. Look at the rent growth. Drop, plummet. That's some pretty big transactions. This is interesting, though. These are all really cheap prices per square foot. Like, really, really cheap. I mean, you're selling $434,000 for $94 a foot. 41 million is a big number, don't get me wrong. But if you were going to go build 434,000 square feet today, you'd be spending more than that. Asking rents hold steady. Of course, they want you to reach out to get all of that information. Let's see if there's anything else in here. Nope. Oh, they just teased us. All right. So, John, I am not fired up about this deal. To me, it seems like you don't have good rents. Seems like there's not a lot of demand. And so we're going to have to really bake that into our assumptions as we underwrite. The problem is we literally have no leasing comps whatsoever. So what I'm going to try and do is another way that I try and find that I work to find some lease comps whenever I can't find any. And that's to go in and look at commercial properties for sale, and see if we can find something in the offering memorandum. Let's go to filters. Don't want any owner user. I want triple net or absolute net leases. I want multi-tenant buildings. Occupancy needs to be at least like 30% or more. Let's just see 0 listings. All right. Okay, we got a couple in the area. Let's see. A bank headquarters. That is not industrial, and that is, guys, there's not a lot of retail. There's not a lot of activity going on in this area. I mean, look, I know I'm spoiled coming from Nashville, but this is kind of crazy to see. Like, I would not be buying real estate in these markets at all. Let's just go back to see. Anything. Unpriced. $1 million. $1.6 million. True green lawn care. New 10-year absolute triple net lease. John's here saying present. Only big thing I know of is 3 million square feet Amazon hub, greenlit 5 miles away by the Lorain Regional Airport. That's always a good sign, right? Amazon brings in a lot. When was that greenlit, John? Actually, let's look it up. Amazon Distribution Center, Lorain, Ohio. Let's look it up. Let's see what's going on. Permanently closed. Let's go to news. I am not seeing the new facility is being built in Turtle Creek Township. It is expected to bring 125 jobs. So it's a, all right, well, let's look up where the Turtle Creek Township is. So outside of Cincinnati. $67 million, 1,000 acre mega site. Amazon announcement, Cleveland. Data centers in Ohio. I mean, if there's going to be a data center, it's not going to bring literally any benefit to the area. People get all excited about how big of an investment a data center is, and it's like 2 people that it'll actually employ. It's kind of wild. It's just a giant facility to house computers and drain power. I mean, we need them for AI and stuff, but they don't bring a whole lot. Yeah, John, I'm not seeing anything about that. And with Amazon cutting as many jobs as they are, I'd be surprised. I know Amazon has put a lot of their distribution hubs on pause. I had buddies that were doing a bunch of work for them, helping them find sites, and like all of that got put on pause. If you can, drop that link in the description below or in the chat. I'd love to take a look at it because maybe that'll change it. But okay, so let's see what this is. So the NOI is $100,000 a year on 10,800 square feet. So that's what, $12 a foot, $100,000 divided by 10,800. $9.26 a foot. All right. So we have a comp right here, single tenant net lease deal at $9.26 a foot. This is the only comp that we have. It's a similar square footage. So I'm going to use this as our comp as we actually underwrite this deal. I'm going to assume that we just buy it in as-is condition because I don't feel very confident that we're going to be able to break this up into smaller suites and find any tenants. It just doesn't seem like there's a whole lot of demand. And so we need to be careful about that. So let me get out of this. All right, the property is 9,300 square feet. Purchase price was what, 850,000? Capitalized rehab. I'm gonna bring $5 a foot just to spice it up a bit. So a little more than that, 50 grand. Let's see, closing costs. I'll probably bring 20. It's probably a little high, but who knows? I feel good with a 25% down payment, 7% interest rate, and 20-year amortization. We're going to go for $9.26 a foot net. Now, we don't have any other miscellaneous income. Rent increases 3% per year. So the interesting thing about this, it's single tenant. So as soon as we get it leased, we'll be stabilized. Now, I never underwrite 100% occupancy, even if it is 100% occupied. And you're probably thinking, well, that doesn't make any sense. Why wouldn't you underwrite it at 100% occupancy? And the reason is because over an extended period of time, you will have more vacancy on that property. The tenant will leave, or maybe they don't pay rent for a month, or something always happens. And so banks, when they underwrite the deal, they will actually underwrite with vacancy. Even if you're buying a Starbucks, they're still going to underwrite it at 5%, 7% vacancy, whatever they feel like. And so you might as well do that in your underwriting. Will you cash flow? Will you make more money? Your returns be higher? Sure. But we're not trying to do an accounting of the project with this underwriting. We're trying to see, will this realistically give us good returns over the next 5 years? So let's just assume it takes us 12 months to find a tenant because I can't figure out what's going on in this market, and then we're fully occupied. All right. Now we're going to do it triple net. What I will do is, like, even though you're doing it triple net, since we are, actually, you know what? I do need to pull this from this offer memorandum too. Even though it's triple net, it is still your responsibility when it's vacant to cover whatever those operating expenses are. So let's see what the OpEx reimbursement is in here. I wonder if they have that broken out. They may not, just because it's triple net. But I would want to know that if I was buying this. So surely. Yeah, it's absolute triple net. Okay. Well, we don't know. We're not going to know, unfortunately, because since it's absolute, they don't need to give you that because you don't even need to underwrite it. Let's just assume that it's $3 a foot for the first year. And then after that, we're going to have it leased, right? So I'm actually going to break this formula, drop it down to 1, see how that auto-populates the rest of everything. Now, I drop it down to 1 because your expenses are never going to be truly zero on a property, all right? You're still going to have some sort of asset level expenses. I like to account for those here. We will have 6% leasing commissions. It looks like we do hit a 1.24 debt service coverage ratio in year 4. Let's assume we can negotiate for 12 months of interest only, so we'll leave our principal pay down at 0. Asset management fee, 2%. I'm going to raise capital for this, so we got to charge a 2% asset management fee. 35 cents a square foot on the cap reserve side. I think that that's pretty fair. All right, we'll take 30% for ourselves since we're raising capital for this. Looks like we lose a lot of money the first 2 years. And then, our investors, they kind of make a little bit. Not a lot, not an exciting deal by any means. I think a 6.65% cap rate is aggressive. They're asking a 6.25% cap rate on this other deal, but it's also been on the market for 157 days. So, and it looks nicer. It's true green. I mean, let's assume that we're not going to be able to get a corporate tenant like that. I'm just going to go with a 7%. I still think that that's kind of aggressive, to be honest with you. So that gives us a total return of, drum roll, 20% over 5 years. You are making 4% on your money every single year. Absolutely not worth it. Okay, let's see here. John is saying Lorain County secures. Lorain County secures $67 million in state funding. For 1,000-acre megasite. Elyria, Ohio. They've approved the distribution of more than $67 million from the Ohio and Lorain County. Okay, so apparently they are aware of some of the infrastructural issues in the area. Excited about the economic impact. Opportunities available will be immense. The megasite will be strategically positioned around the Lorain County Regional Airport, which could help reduce the burden on Cleveland Hopkins International Airport and Burke Lakefront Airport, according to the release. Plans include expanding the airport runway, development to solve inadequate sewer systems and water resources. So, John, I would actually argue this might make this property worth less. If this is true, if they are investing all of this money into this area, why would somebody want to go further away from the airport, further away from the action, to go to 7405? So I wonder, let's see how far this is from the airport. I mean, and maybe it's not far. Let's see, directions. Lorain County Airport. Oh, 21 minutes away? Oh, yeah. That's not going to have any impact on this property at all. And in fact, it'll probably be negative. Because if I'm a tenant, why would I go out here when I could go right next to the airport that's getting all sorts of new infrastructure, and there's big tenants going in over here. Like if you were 5 minutes away, like maybe over here, I could see it, maybe even over here, right off the interstate. I think this could be potentially not a great thing. I wonder how Amazon is involved, though. Yeah, I mean, it looks like this is more of just a county initiative, state initiative to create this industrial, I guess, megasite, as they're calling it, which is great. It's really, when you see public investment like that, that's going to be awesome for businesses in that area. So, I mean, I would be looking right now to buy anything in this area, anything along Russia Road. That's one of the things that you could do is just pay attention to news announcements like this, stay in touch with what's going on in your area politically, and then as soon as something like that happens, start buying in these areas, because they're going to invest that money in there, and it's going to make the property worth a lot more. So, all right, bringing it back to our underwriting, the only way, I feel pretty good about $9.26 a foot. I don't think that if we sign a lease in 6 months, it's going to make a difference. I really don't. We could try it. Let's see what it does. Let's say we're only vacant for 50% of the year. And our returns go up to 33% overall. Still horrific. Remember, we want to get those to 100% because that means that we've doubled our money in 5 years. So I'm going to keep this at 12 months of vacancy. And there's only a couple of levers that we can pull, right? One is the price. We're not bringing much in capitalized rehab. I think you should have that. I mean, maybe you can lower your down payment, but then at that point, is it realistic? I don't know. I don't know that we can get really more compared to our comps. I don't know why our property would be worth more than a comp that has brick exterior. But even if we get $10 a foot, let's just say we are able to work our magic, you're still only getting a 41% return or 8% annualized cash on cash. Not going to be worth it. And you know what I would typically do in a deal like this is I would go through and I would start to stress test it if it was close. But the problem is this one's just not a deal to me. The only thing that would realistically make this a deal, I'm going to drop this back down to 926. I bet you'd have to get this for close to $550,000. So we drop it down to 550. And look at it. Okay, we can pay more. That's high. 129%, right? So that's a 25% annualized cash on cash return over 5 years. That's pretty decent. I'll take that. That means that we could pay a little bit more. So maybe we offer 550, right? We start there. And we can negotiate. Can we negotiate up to 600? Will the deal still work at 600,000? And it does right there. 600,000 is the most that you can pay for this deal. Like backing into the numbers that way. That's what it looks like to me. That's where I would cap it. I would not pay any more than 600,000. You know, we go through and we can look at all of these numbers. You know, there's some numbers that I like to stress test and we can, you know, kind of play around with, but a lot of this stuff, if it's based on comps, you've looked at it, unless you feel unbelievably confident that you're going to be able to actually achieve those numbers, there's not a lot else that we can manipulate in here. Maybe we can get 18 months of interest only, and so we take part of the principal reduction out, but look at that. It's only $11,000 a year. I don't think taking $5,000 out of our expenses is going to totally change this deal. You know, we're going to have to pay the operating expenses the first year because there's no tenant there. So there's no way to get around that. We're still going to have, you know, roughly $10,000 a year in miscellaneous expenses. You could probably argue, okay, well, actually, I'm going to do all the bookkeeping myself, and I'm going to send out the investor K-1s myself and file all the tax returns and everything myself. But again, it doesn't, I mean, that starts to actually add up right there. That's kind of nice. Okay, if we do that, and that's the case, then maybe I can pay up to $625,000. But we're like splitting hairs at this point. Probably a little bit more. You could probably pay up to $650. But like then you've got yourself a job, right? I mean, it's not easy work. I would rather hire an accountant. But it does make your cash flow to your investors look a lot better, right? Like that's when this deal starts to make sense. So if you're willing to do a lot of the accounting work yourself and keep your asset level expenses super low. Now keep in mind, this also means like this number here is I'm hiring an attorney to help us negotiate a commercial real estate lease. That's where I would throw that, like professional fees. I would throw that into those expenses. Professional fees also includes your CPA, your tax returns, you know, K-1s, buying pens, stamps to mail stuff to your investors, whatever that is, right? Could you negotiate on the commissions? Sure. Maybe you get it down to 5%, right? Again, negligible. But that's probably where I would cap it. I think $650,000 with the way that we've just looked at this is the absolute max that's going to make sense. Yeah. Now, I mean, you could say, well, Tyler, 20% annualized return over 5 years is really, really good. I'm willing to take a 15% annualized return. And great. You know, I wouldn't because I have all these other opportunities where I can make 20%. And if you annualize 20% compared to 15, I'm making 25% more. I'm getting basically another year's worth of income in 5 years compared to you taking 15%. So you got to think, like, is it worth tying up my time, energy, resources in doing a 15% deal when there's 20% out there, right? But let's just say, yeah, you are willing to take 15% annualized cash on cash returns. Maybe you can pay $725. Yeah, so almost to the dot. You could pay $725,000, but keep in mind you're only getting 15% annualized cash on cash returns, and you're having to do all the bookkeeping, all the accounting, try and cut out the professional services fees as much as possible. So there you have it. I think it's a marginal deal. I probably wouldn't do it. But if you think that, hey, maybe there's still something here, maybe you can get it for $650,000 and it might be worth it. Maybe you can lease it up a little bit faster. The next thing to do, start calling the brokers. Call brokers in that market, figure out what's going on in the world of flex space, because something to me here doesn't seem super realistic with what's actually going on in the market. There's something funny with the fact that you've got several industrial properties listed for lease at undisclosed rates and not a lot of comps in the area. To me, that just screams like, hey, this is probably a bad market to be investing in. And the market data that we looked at from a brokerage firm, which you guys can find that for almost any market that you're investing in. If it's a small tertiary market, like Lorain, you may just have to look at Cleveland, the nearest big city overall. But that's going to give you some pretty good data as to what's going on, because if Cleveland is struggling, chances that Lorain is doing well are pretty slim. And in fact, whatever issues Cleveland has are probably magnified as you go further and further out. So there you guys have it for this week's 30 Deals in 30 Days, day 11. Stay tuned, because this week I'm actually going to bring in one of my previous projects. We're looking into this now to see which one it would make sense to do this on, and take my original underwriting, review that from like 4 or 5 years ago, maybe even 6 if we can find one of the older ones, and then compare it to today or how it turned out after we sold it. I think that would be a fun autopsy to do with you guys. So again, thank you guys for joining me. I will see y'all tomorrow for day 12. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.